So let's go to private credit. How do investors see private credit relative to bonds and larger liquid loans? And how will they view private credit?
Folks are viewing private credit very favorably. If you can get comfortable with giving up some liquidity, it solves a lot of issues in terms of the asset class having far less volatility in underlying asset values and much more predictability in terms of your return. I think LPs are viewing private credit right now as having a very low standard deviation of returns. It's a very steady and predictable dividend yield and IRR throughout the cycle. It's low duration since loans are floating rate, which is very, very favorable in this environment. So I think it gives investors a more stable and defensive portfolio allocation that they can count on.
Thank you, Fran. Now I want to talk about opportunities. And to that, I'd like to turn to Dan and Randy. So where do you see the opportunities and where are you more open to doing deals?
I think in terms of opportunity, I'm excited about the stuff that's going to be reopening. I think lenders will be coming back to that space in 2022, 23 as they normalize. I think a lot of people will be reluctant to dip their toe in the water initially, and that's a dynamic that we like. And so, you can be very, very selective. That's where we see opportunity in the coming quarters.
Yeah, Dan, I think that's a perfect description of what's going on out there. And what we had turned down is like 93% of the stuff that comes in. We always thought, look, when the next recession comes, we're going to be like the squirrel that stored all their nuts for over the winter, right? And then we woke up in March and realized that all that work actually paid off. We had no defaults related to COVID at all last year. So there's actually no real opportunities that are different. We're actually now, the thing was like, okay, we're going to be able to commit large dollars with sponsors that know us. And that turned out in 2020 to be the winning formula, because at the end of the year, we had a record fourth quarter, a record year. And what was weird was we were closing deals in November with a sponsor that said, oh, by the way, you're doing such a good job on this one. We have another one next week that we need to close by year end. They were so familiar with the way we work and our credit agreements, and that's half of the issue, right? If you negotiate credit agreement and there's a lot of time spent doing that, it's like, well, let's use the same one. And so there was the ability to commit a large amount and then just have these relationships. That's the opportunity.
Thanks, Randy. In our last section, we want to talk about the outlook for direct lending. And Fran, you talked about it. Let's start with you about, this year in fundraising, and we track fundraising numbers too, and it was a huge year. We expect another big year. So are we primed for another round of this growth that Fran described so beautifully a couple of times, this accelerated growth? And if so, what about the new entrants coming in now? Is there a higher bar? Is the bar set higher for them?
I do think, direct lending is going to continue to grow. It's going to continue to take market share. This is where I see a lot of growth coming in that's new. First from the retail channel, that's getting more and more exposure to direct lending through new products. I think retail investors are very yield starved. They don't have as many attractive alternatives to some pension funds and qualified investors. So I see money coming in from that segment. And secondly, I think foreign investors, European investors are looking for very tax efficient vehicles, and they just don't have the same yield and interest rate opportunities in their continent that we have. So I do see money continuing to come in from those areas. Just in terms of new entrants, you're right, like from 2012 to 2017, we saw a flood of new entrants, but beginning in 2018 and 2019, I will tell you, it got harder, right? The market became more saturated, and you just had too many lenders that kind of do the same thing. And some players at this point have just so much scale and so much market share that I just think in this next cycle, the bar is a lot higher. So I think it's going to be much harder now to see new entrants come in, especially if they have a limited track record and they don't have a differentiated strategy. But overall, I think we're going to still continue to see the growth. I think it will moderate a little bit.
Thanks, Fran.
I think the lesson that is going to be learned is that, you have three cases for your models that you run for the deals. You have the sponsor case, you've got the base case, and you've got the downside case. We learned last year that there's a fourth case. It's the no revenue case, okay? And that's the one that you have to run to sort of see, okay, what if we have a shutdown, for whatever reason, what happens to this business? And the corollary to that is if you offer a revolver to a sponsor and a client, they will draw it fully drawn when they need it. So those are the two lessons we learned.
So I would just say that my lesson learned through the pandemic, and it really go back to pre-pandemic, it's know and stick to your strategy. And just, in good times and bad. That's what we have LPs and leverage providers telling us is our portfolio held up relatively well. We have our challenges, don't get me wrong. But on a relative basis, it held up because we were less frothy. We tended to stick to our knitting and frankly lost a lot of deals. And I spent 18 and 19 trying to convince my partners we should be doing those deals. And when I brought them to them, they keep saying, no, bad Dan, stop doing that. And I was very frustrated at the time. I am extremely happy that they did that they held the line. And that's not a GameStop reference, by the way, just to be clear. The last thing I'll say, just through the darkest days, as things got darker for me, it was more important than ever to just punch in every day and do the work and just kind of continue and rely on the incredible team that we've built. Very fortunate to have them, and they protected me from myself and my worst instincts, which I appreciate.
Dan, thank you for rounding that out. And it reminds me of, Randy, some of the comments you made about sticking to your strategy consistently. And that's obviously the strategy you're selling to your investors. So you're doing right by them too. And Dan, I want to thank you and Comvest for sponsoring this, and Lena and Opus Connect for hosting us and allowing us to have this discussion together. If you couldn't tell, we have a lot of fun up here.